So if you're going to stay in, where should you be putting your money to work? Let's ask that question to our friends on set here. 1 Point BFG Wealth Partners Chief Investment Officer Peter Bookvar and ER Shares Chief Investment Strategist Eva Ados. Welcome to both of you.
Thank you.
I think that's it. I think what we've learned, right or wrong, and our viewers can disagree with this, Eva. They can hate what I'm about to say. But the AI trade spending is superseding, for now, the costs and risks around the Iran war. Fair or not?
Fair. And the question is, and the puzzle is, last year, 4 hyperscalers, Meta, Microsoft, Amazon, and Google, invested $443 billion in AI CapEx. This year, they're projected to invest $680 billion. The question to us is, where is the ROI in AI? We saw what happened with OpenAI, they missed their targets, and we're looking for that ROI. Yeah. And today we'll discuss later, we think we have 3 companies, I call it the AAA basket, where we can find this ROI. So it's a company-by-company basis, and you should look at the company's financials to find that.
And I think that spending, that $480 billion you referenced, that spending is going to go to jobs, it's going to go to construction, it's going to go to earnings, and the market is more focused on that than the effect of high gasoline prices. Right or wrong? I'm not saying it's good or bad, but that's what's happening.
So what we are analyzing is the investment in AI infrastructure. So what we're saying, on the one hand, you have the war, and we're all concerned with the war, but we do see strong earnings. And the reason why we see strong earnings is because the AI has allowed many companies, not every company, but many companies to widen their margins in an unprecedented way. So the way that we see that is on a company-by-company basis, looking at the company's financials. And there's many examples of companies that all this CapEx investment has materialized. But also there's other headline names that we're looking at that we haven't seen that being translating in margins being wide enough to prove that AI has been used.
You had referenced, Eva, the AAA.
Yes.
All right, so let's get into one of them, Arista Networks, because we talk about Meta and Microsoft and all the big names. Well, those data centers require a lot of stuff from a lot of companies.
Exactly.
Arista is one of them.
Yes, this is more of a front-end CapEx capture, AI CapEx capture, because when hyperscaler invest in AI infrastructure, that flows directly into the AAA that we're going to mention, and one of them is Arista. So anytime a hyperscaler invests in their AI training infrastructure, that flows to Arista switches, for example. So what we like about this company, and we've been long-term owners of it, holders of it in our XOVR ETF, is that it's been very consistent. And who doesn't like a consistent player? Their revenue growth has been consistent year over year, about 27 to 29%. And their margins are holding their ground too, which for a company which is a $200 billion company plus, and it's growing its revenues, it's very rare to see margins being so stable. So the gross margin is 64%, the operating, the EBITDA margin is 46%, and they've been consistent, not exactly, but very close to that, which is what we like. And one detail that a lot of the market doesn't know is that they are partners with Amazon. So when Amazon...
Is everything an A? We have Access Capital later in the show.
Amazon Alphabet.
Today's show is brought to you by the letter A.
Yeah. So there is a $6.5 billion warrant agreement with Amazon, and every time Amazon buys their infrastructure, then that vests through that warrants, and that will vest through 2033. So Amazon has an economic incentive to see Arista succeed.
I mean, also on here, we have Astera Labs, which is an infrastructure layer. The one that surprises me is AppLovin. Yes. That's the one where I didn't see that one coming.
Yes. So this is an indirect play. We've been holders of this for many years, and I've been a fan of this company for many years.
Market hasn't been, Eva. I don't want your mom is here, so I'm trying to be nice, but the market is not like AppLovin this year.
In the last 3 years,
I'm sorry to your mom.
In the last 3 years, the company is up 1,500%.
Wow.
Obviously, there's the SEC overhang, and there's the question with data, security, and everything. But we need to recognize that when a company goes up 1,500%, it attracts short seller interest. And I'm not saying that we should invest or we should, be negligent to the data that has come out and the questions. But until that's proven, the numbers that AppLovin is showing are tremendous high. So we're speaking about revenue growth of 70%. We're speaking about SG&A costs coming down from 11% to 7%, and EBITDA margins going from 67 to 77%. These are amazing numbers. This is a company that made a cookware company scale from $4 million in revenue to $80 million in revenue. And that was through the AppLovin Exxon platform. So
crazy.
It is crazy. It's how AI works.